Welcome back. We're with Andrew Dreschner, who's going to help us with accumulation. Andrew, thank you for joining us.
Hi Kerry, thank you.
The last session we did on accumulation was Cameron in the park, and it was quite cold. I think you can see that from what we were doing. We weren't both quite shivering, but it was very close. When we've spoken about asset allocation, what I want to cover with Andrew now is risk profiling. It's a way of determining or helping you determine what your asset allocation might be. Andrew, can you tell us a little bit about risk profiling?
I think you've almost stolen my thunder there, Kerry. Essentially, it's a tool that you can use to measure your tolerance to risk. And like you did say, it is important to then use for asset allocation. So to know how much to invest in various asset sectors. I mean, everyone's different in terms of their risk profile. And it is just one measurement, I guess, in terms of how to invest your funds.
So Andrew, risk profiling, for somebody to find out how to allocate their funds, they need to risk profile. What sort of things does risk profiling actually cover?
One element, which is an important element, is in terms of liquidity. Okay. So it's measuring in terms of how long you need to invest the funds for.
Can you give me an example or a story of somebody who's got their liquidity wrong and what happened?
An important case which springs to mind is someone who's saving for a house deposit, for example. So they may have a time frame of 12 months or 18 months, and realistically in those circumstances they need to invest their funds purely in cash, I guess.
Okay, so if they had them in shares.
That's right, that's a mismatch.
Yeah.
So clients, I have seen the situations before in the past where clients have a short time frame, but they invest their assets in growth assets where you should have a 5 to 7 year time frame. So that's a real mismatch there.
So really then, if you were a very, very, very aggressive investor, but you wanted the funds in 6 months, you'd be investing very securely.
That's correct.
Yeah.
That's correct.
So we begin to understand why we have to profile in this way.
Yeah, profiling is just one tool. I mean, it's not the be all and end all. It's an important tool, but there's also other considerations, and time frame is one of those considerations.
I guess another consideration would be investor experience.
That's correct, because that has a big impact in terms of clients' risk profile. Because if clients are experienced, they're invested in shares which have fluctuated in the past, for example, and the markets are moving up and down, then they, of course, may be able to handle the sort of fluctuations in the markets.
Okay. Another element of risk profiling would be risk. So how much risk a client could accept. Could you tell us something about risk and how that might impact a client, and even an example from people you've dealt with that would emphasise it?
In terms of risk, most clients, when they think of risk, they think of the propensity to lose money. So the questions in risk profiling tend to be around, what would you do if the value of your investments went down 20%, for example? So what we're trying to gauge there is reaction of what people do. Would they instantly take their money out, even though they had a long time frame? So that's the importance there.
Something that I probably should have picked up very much earlier in terms of risk profiling, of course, and I probably didn't because we've covered it well, is objectives. They're incredibly important in terms of risk profiling.
Yep.
How do you find objectives play out in people's affairs in relation to risk profiling?
Well, I guess it isn't uncommon for people to have different risk profiling in my experience. So they may have certain objectives regarding their superannuation because it is a longer term investment, there's a longer time frame, whereas they may have other pockets or amounts of money to invest where they've got shorter time frames. So I think your objectives are very important, and you can have a number of different objectives and therefore almost clashing risk profiles.
Alrighty, so in relation to risk profiling, again, I guess inflation would be an important element?
It is a factor that you need to consider, of course, in terms of whether you want your money to keep pace with inflation over the long term. And that typically is a question that you see on most risk profiles. Okay,
taxation, I guess that's a key because certainly lots of people invest purely for taxation. My accountant says I've got to.
Yep.
Yeah. Can you tell us a bit about that?
Yeah, well, once again, it is a question that you do see on a lot of risk profiles. A lot more aggressive type of investors do have that as a major concern. Of course, you wouldn't want to invest in things purely for tax purposes. There has to be underlying investment fundamentals there.
Although people have.
People often do, yes.
And continue to do so.
Indeed.
Yeah. The final thing, I guess, in terms of risk profiling is investment preferences.
Mm-hmm.
So somebody might come up and say, I don't want to invest in old mutual, I don't like them.
Mm-hmm.
Or My brother-in-law did magnificently well in green potted plant. We should have some of that.
Yep, yep.
How does that? Can you tell me a story about people in your experience who have done that, and did it work for them? Did limiting their investments achieve the outcome they wanted?
Well, it's an interesting one because everyone's different in terms of their risk profile, in terms of where they should invest funds, in terms of their objectives. So it's very difficult to say just because my neighbour's invested in something, therefore I should. You may be totally different in terms of your risk profile. They may be very aggressive, you may be conservative, they may need to invest that way to reach their goals where you may not. So why take that extra risk? Often when people do invest, just on the advice, say, of a friend or something they've read online, that's when they can lose money because it is a bit of a gamble for them. And you hear all the time in terms of, one case I remember is a client who bought some shares in a small mining stock because his dad said they were a good deal, even though his dad didn't buy the shares in the stock. He recommended that he did, and he lost that money, which was also an important life lesson. So.
Look, thank you very much, Andrew, for spending time with us again, and you know, we appreciate the knowledge that you're prepared to share with us.
Okay, thanks, Gary.
Okay, we'll go to a break, but before we do that, let's just recap. We've spoken in the past about asset allocation and how important it is to mix the asset allocation to achieve your outcomes. With risk profiling, what we've tried to do is try to give you some clues about where to look to achieve the asset allocation. The other rule I gave you earlier was much simpler than this, and that is invest as riskily as you can to achieve growth. Not quite as clever as what we're doing here, but if you are lazy, it might put you in too much trouble, as long as you stay there. Okay, see you after the break.